Welcome back to Business Week here on Arise News. As global power structures shift and new economic paradigms emerge, a new report from commercial partners titled Reconfiguration from Global Trade to Quantum Innovation offers a deep dive into what's shaping markets, nations and investor behavior in H2 2025. From U.S. tariff shocks and Nigeria's fragile reforms to the rise of resource-based diplomacy and quantum breakthroughs, the report signals a dramatic turning point for global economics. Ifeanyi Ubah, who is head of investment research, commercial partners, joins me now to discuss this further. Good morning to you, Ifeanyi. Many thanks for joining us on the show. Great. Well, let's begin with this report. Well done to your firm on this to begin with. The report describes 2025 as a year of tariffs. Very well, very apt, one can say, right? Yes. But how have U.S. protectionist policies affected global trade flows and inflation risks?
Well, we anticipated this tariffs push to have increased volatility in the market, and that's exactly what we saw. We see Donald Trump bringing the Trump card, which is the tariffs, to actually bring people to the table to renegotiate the trade deals. You see, U.S. was a massive exporter of technology and goods, and right now they have been in a trade deficit for long. So looking at a way to shift the dynamics, because the world powers and the world players are going to change the dynamics moving forward.
All right. We're witnessing some sort of shift from financial dominance to resource-based global order. What does this Bretonwood 3 mean in practical terms?
Oh, definitely. So for you to understand the Bretonwood 3, you need to understand the Bretonwood 1, which was the first one that pegged all currencies to US dollar, and the US dollar had the gold standard, right? So commodities was the talk of the town, and right now the US commodities is around 80,000, and they still have it on their books as 45, which we think would change very soon. Some people are even saying it might push as high as $15,000, which will have a spiral effect on the global trades, even global markets. But the Bretonwood 3, its foundation is based on after these gold standards was dropped in the Bretonwood 3, in Bretonwood 2, when the US adopted a fiat currency kind of regime. But the 3 started as a result of the Russian invasion of Ukraine. We saw trade policies and globalization being weaponized in terms of sanctions. Russia had over 600 billion in foreign reserves and could only hold on to 300 billion. So it sent a signal and a ripple effect to the whole world that if you don't align with the US policies, you could see yourself at the tall end of the stick and short end of the stick, and that changed the dynamics. So it's actually going to be pushed by China in the commodity market. So if you have the US dollar, but you don't have the capacity to buy these goods that you need, what's the use of the US dollar? And we have seen the emergence of that. So the first tactic that could be used is definitely to reduce demand for the USTs or reduce foreign reserves in the US dollar. And we have seen China do this. Even if the US reserves holdings hit an all-time high, we saw China drop into the 3rd place while UK has increased their holdings. I think China holdings of USTs is around 700 billion. But the implication is not just the reduction of the USTs. The implication is the push from push to commodities. We have subprime commodities, particularly sold by Russia, right? Oil in the Russian market is around $45, and we know where oil is around in the international market. But if the demand increases and we see China push, we might see increased inflation and even increased flight costs, because these ships that are being used to move goods and services up and down are in short supply. And when China starts increasing their demand for commodities in order to self-sustain and other people, we will see an increase in this cost. And even if China doesn't decide to reduce their USTs or US dollar holdings, they could just use renminbi to start increasing the prices of those commodities and increasing the cost of shipping, which will have an inflationary effect, lower dollar, and give people another consensus. We have seen commodities even like cocoa move from $4,000 to $10,000, and lithium has become very important because we're seeing an AI age, and this is going to be backed by battery power technology. We are seeing humanoids posing to come out in the next 20 years. So you probably might have a robot sitting beside you doing this anchoring right now.
Right.
And all is going to be powered by this battery technology called lithium.
Right, you know, very robust analysis there, and quite a number of moving parts, but of course we see some very fundamental drivers there. If we look at the emergence of a multipolar world, like BRICS, for instance, in what ways is this changing investment climate and dynamics, especially for risk globally?
So BRICS is a very, very important topic to put on. You see, even before Donald Trump came into office, he threatened the BRICS community of sanctions because it speaks to this using the dollar less, and the hegemony, which is the US, gets their power from the use of this dollar. But if you look at it, if you decouple it and you look at even Nigeria's trading partners, we trade more with the BRICS nations than we trade with the US, right? So we trade more with China and Brazil and other countries, right? So it's talking about having to let go of this dollar and self-sustaining individual economy. And we have seen countries like China that has, in the last 50 years, fought no new wars, but has increased their capacity and increased their commodity stance. So it's a huge topic on the table, and the West is going to try their best to detour that movement because it doesn't fit their ends. So, right, the ends justify the means, and everybody's playing a game in this world.
Right, the end certainly justifies the means. But then despite fears of recession, the US has shown very surprising resilience in the face of all of this. What's driving the stability?
So the fears of recession was more headline than actually core. When we decouple it and we saw that the real growth was not declining like we saw in the 2008 and 2000 and with the COVID crisis, right? Although we saw a decline, we are seeing a re-emergence because import has actually reduced drastically. So people were trying to hold for the tariffs and seeing it as a change. But now that things have settled down, export has actually increased, which has actually pushed the US economy larger. When you decouple it, the last print of non-farm payrolls saw that there was a massive government employment, and this print of non-farm payroll actually went below expectation, showing that the inner workings of the US is still fragile.
Wow, the fragility is also a very important point you just raised here. Now, looking at this report, Ifeanyi, it warns of long-term risks from U.S. public debt and structural imbalances. How serious are these threats?
Yeah, so on a large-scale basis, when you look at it for a long number of years, we saw that the private sector credit has always been the one to propel the economy in the US, and the public sector credit comes in times of recession and bailouts. But right now we are seeing that spending has actually increased massively even when there is no recession at hand, and this is a change in dynamics. And with the big beautiful bill hoping to add around $5 trillion, it begs the question of fiscal discipline in the US economy and how sustainable is this borrowing.
I mean, let's look at Trump administration's fiscal reforms. Do you see any credibility in it?
Yeah, so definitely we have some good suggestions for the big beautiful bill, like he calls it, right? So
suggestions,
like implementations, right. In fact, right? So we see permanent holdings of tax cuts, and tax cuts is expected to propel the economy. We even see stuff like no tax on tips, and we even see the $5,000 for babies and other implementation that actually went ahead with his campaign promise. But the problem there is it kind of begs the question whether it's more political than tactical, because in the long run, it begs the question of fiscal discipline, like I said. How will the US continue to sustain a large deficit, and what is the long-term effect? And we have seen that projection says it's going to add like $5 trillion. But this bill is also supposed to propel growth, as you know, there are now reforms around how you expend research and development, which is going to propel more research and development into stuff like AI and innovation, which is something we need to see more from home. So I think there are some parts we can learn from it and some parts that we have to discard.
But let's take a look more at these suggestions that you've come up with in terms of recommendations. What could possibly stand in the way of implementing that from a US perspective? Well, successfully being the key word.
Yes, so the bill is supposed to have a large disparity. So yes, we see some concessions for the average American, but it disproportionately pushes more wealth to the wealthier. And we've seen that any civilization that increases the inequality gap doesn't really hold water anymore. We did an evaluation in our report of different hegemonies, and we see that inequality gap is a good factor of knowing how much they can sustain their growth. By the time the lower bottom of the country is feeling the pain and feeling the growth, there might be crises and there might be insurrections that might deter the smooth sailing of the government. And this is just internal concerns. We still have external concerns like the BRICS and other countries that are trying to have formidable holdings and beef up their security. We saw Russia reduce their holdings of USTs before invading, and we see China significantly reducing their holdings of USTs as reports from Sky is telling us that there might be an invasion in Taiwan. But all these things are different moving parts. That's why the Taiwanese government, our citizens, don't have a problem getting the US visa, because in my opinion, it's a promotion of kind of like a brain drain where people that know how to make this cheap technology find their way back to the US in order to push it to the greater frontier.
I'm glad you mentioned that, because I'm about to ask you about the relational implications of, implementing these reforms. For instance, with Nigeria or Africa at large. I'm glad that you've mentioned some Asian countries. What about a spillover effect on countries like Nigeria?
So it's depending on how the game is being played. Right now, we are seeing the threat of sanctions from making allies for the BRICS, for example, right? But in one way or the other, we have seen the emergence of the euro dollar because of the trade surplus countries have. But the euro renminbi will be another market to look at, because China is actually expanding. And like I said, Nigeria has one of the largest trading partners is China. So it begs the question, to how much do we need the reserves? And Nigerian government has actually been maintaining a surplus. So let's see how it goes. All
right. Well, speaking of Nigeria, we've seen the economic reforms between 2023 and 2025 echo the structural adjustment program of 1986. How different are today's reforms, and what are some of the early signs of impact?
So one of the big difference was that we saw massive growth within a couple of years in structural adjustment program from 5, 8 to even 12% in GDP, right? But there are so many similarities. It was more or less like a deja vu effect, right? Calling for fiscal discipline and devaluation of our currency. And we have notes in our report that the currency actually devalued over 200,000% since the inception of the Naira. So it begs the question, the devaluation principle, does it really help us or does it mar us? So the devaluation was something that the international firms have been shouting, but we held strong. The previous central bank governor, even though he has so much faults, had a little bit of headway in that, because he maintained that we needed to have this as a temporary fix. And by the time we're able to fix our export and import dynamics, we'll be able to float the currency and see how it happens. And right now, I think we are on a trajectory to actually fixing our trade dynamics. As I've said before, we are in a trade surplus and we're exporting more oil, and we are looking at almost a 5 trillion Naira trade surplus. If this is sustained and this is maintained, you see the Naira grow more. And we could actually even see, at the best case scenario, in a couple of 5 years, if this trajectory maintained, we could see us move back to less than 1,000 Naira to $1.
Right, that sounds quite positive, but with the Naira stabilizing and with the expectation that inflation is expected to trend downwards, would you say we're finally on a sustainable growth path? You've alluded to it positively here, but how do we buttress that? Are there some hidden risks, for instance?
Yeah, definitely. Definitely kudos to the CBN governor for keeping rates high and maintaining it steady, and also the liberalization of the FX have seen earnings for for the companies in NGX skyrocket because you don't need to report FX losses anymore. So there's more stability, and we have seen inflows in FDIs. So this is actually core in moving Nigeria one step forward. But for the long-term sustainability, we need to look about the FDIs, the long-term inflow of money, and keeping it for a longer term. And also look at sustainable financing or developmental financing, which is the core. We need subsidies in stuff like fertilizers, pushing people more to agriculture and production, which is something that has not still been seen. Although right now we are seeing the numbers hold true, it is difficult to actually know when this is going to hit the table. And one thing to note is that aside from the numbers, because nowadays we see the numbers decoupled from reality, Commercial Partners Research actually went on a triangulation analysis and did a qualitative analysis where we shared out questionnaires and looked at response. And one of the striking stuff was that 80% of people actually most of our respondents said 80% of their income was spent on food. And we still see food on a massive trajectory. And with no subsidies on that, on fertilizers, we could see prices of food skyrocket. We could actually deter what has actually happened in terms of inflation.
Right, but perhaps you could help crystallize this a bit more clearer. When we look at foreign portfolio inflows, they have surged. But then we look at FDI, and there is a dip there. What's the underlying reason for this divergence? And how should policymakers respond, more importantly?
Well, like, it's no brainer for the FPIs, which is the hot money in terms, right? Because we are issuing our bonds at very high rates. So when you look at the differential, it's hot money for them. And we've seen skyrockets in both international participation in the Nigerian stock exchange market. So the stock exchange market is doing around 37% right now. So it's a no-brainer. But the FDI is the more long-term money. It's like, if I could put this in an analogy, your FPI is like your friends with benefits and is ready to go home. But your FDI is saying, I'm going to be here for the long run. It's like giving you a ring and looking at more sustainable and infrastructural development. And that's where we actually need, and that's where we are seeing investors lack. So we need to push for more investment confidence in Nigeria and create the structures that allow preservation of capital.
All right, quite the analogy there. I get the point. But where do you see the biggest opportunities for H2 2025? Equities, commodities, crypto, where?
That's a dicey case. So if I was doing an analysis for just equities and commodities over a 100-year span, it's definitely equities because, you know, they have outperformed even in the long run, right? But when you zone it down, the crypto has not actually had 100 years to stay. And with the new policies and the Genius Act and everything that's going, we're looking at a shift into tokenization of almost every asset class. And commodities, like I said, with the Bretonwood too, we're seeing commodities pump up. I think gold has done over 25%. Even if there was a little pullback, that's still enormous for half year. So if I was to rank them, I would say crypto is where you're going to see the best, but the volatility in the market is something to question. But the volatility was what we actually pictured out. We saw that in the United States, we have asset managers like BlackRock and Vanguard push money into the crypto market. And we see that this crypto run was actually done with the lowest volume compared to other runs, meaning that signal that there was more stable capital and more institutional money flowing into the cryptocurrency market. And with countries adopting more cryptocurrency and stable coins, we could see that asset class actually balloon beyond what our expectation is.
Now, you know, volatility is a key word you mentioned there, and, you know, we have to look at it specifically when we look at the Eurobond market specifically. How should African sovereigns manage debt in this environment, especially with commodity-linked risk?
Well, buy low and sell high. That's definitely one thing to put in mind. But the timing of the market is actually very delicate. So if you bought in the early January and you saw the dip and sold, you'll probably be holding a loss right now. So I think for you to navigate the volatility, you need a more long-term outlook, because one thing we have seen is that trying to time and predict the market might be faulty, but staying in the market for a long period of time, you're definitely guaranteed some success.
But speaking of long term, if we have to get a little more specific, what strategic shifts could governments, start to implement for businesses and start to plan now, especially with the convergence of trade alignment?
Yes, so definitely we need to start looking at self-sustainability. If we can't feed ourselves, we can't grow. If we can't put food on the tables for the average Nigerian at a cheap cost in such a way that they don't erode their income, we cannot grow. We need more investment in our agricultural sector. And since we are seeing commodity as the next big hub, we need to actually invest more and become massive commodity exporters. Part of the development will be setting up commodity funds and investigating more research into this and giving grants to actually beef up the economy that could implement strategic milestones. Like I alluded to, lithium has become more of the desired commodity. If we actually looking at the net zero perspective that the global powers are pushing the world, it might seem that what we have, which is oil, will become less useful in a matter of time. So if oil accounts for close to 70% of our exports. So if we're looking at long term, in 20, 30 years, when EV cars and AIs are everywhere, where will Nigeria be? We need to start shifting the dynamics and making sure we're at the front end of the change, not at the back.
All right, I love that. We have less than a minute left, and I just want to, you spoke about self-sufficiency. Would you say this needs to begin, is this more of a governmental responsibility, or could businesses start to employ this very briefly?
Definitely. I think it's a little bit of both majorly going to be pushed by the government, but the public-private partnership is definitely there. We see the Mark 7, for instance, like these top American countries that are making breakthroughs. Tesla will have been gone without the government subsidies. Even if there needs to be innovation in the private sector, there still needs to be a push that makes entrepreneurs want to also put in their money where their mouth is.
Absolutely. If you joined us midway, I've been chatting with Ifeanyi Ubah, who is Head Investment Research, Commercial Partners, and we've been chatting about the new report from your firm. Ifeanyi, I want to thank you so much for joining us, and we'll see you again very soon. Most welcome.